Today, we are diving deep into MidWestOne Financial's second quarter earnings call. And let me tell you, on the surface, the numbers looked bad enough to spark a pretty big sell-off. But if you look just past those headlines, there is a much more interesting story playing out here. So let's break down what the market might have missed.
And boom, this is the number that just shocked the market. MidWestOne reported adjusted earnings per share of 49 cents, when the consensus estimate was 77 cents. That is a staggering 36% miss. You see a number like that, and it immediately puts investors on the defensive.
So, how did the market react? Well, not well. The reaction was swift, and it was decisive. On the day of the call, MidWestOne stock closed down over 4%. And look, it wasn't just a bad day for banks. They underperformed both their regional banking peers and the broader market. And get this, the trading volume was nearly 3 times the daily average. Clearly, that earnings miss set off some serious alarm bells.
But here's where the story gets really complicated. I mean, this is the head-scratcher. While earnings absolutely cratered, the bank's total revenue actually beat expectations by 1.5%. So you have to ask the question, how on earth does a company miss earnings so badly while actually bringing in more money than expected? Well, the answer lies in one single very problematic asset.
That's right. The entire earnings miss, all that market panic, you can trace pretty much all of it back to a single loan that just went sour. So let's zoom in on this one asset and see exactly what went wrong. The culprit was a single $24 million commercial real estate office loan out in the Twin Cities suburbs. During the quarter, the bank had to move this loan to what's called nonaccrual status, which in the lending world is a major red flag. So what does nonaccrual even mean? Well, think of it this way. It's a loan that's in so much trouble, the bank basically has to stop pretending they're going to get paid. They can no longer count the interest as income, and even worse, they have to set aside a big chunk of money, that's called a provision, just to cover the potential loss. And that provision, it hits the bottom line directly. And that, right there, explains the earnings shock.
Now, this quote gets right to the heart of management's entire narrative on the call. The CEO, Chip Ree, was emphatic. He framed this as a one-off problem. In other words, he's telling investors, hey, don't panic. This isn't systemic rot. It's a small, contained fire, and we've got it under control. They really want you to believe this was just a blip.
So if we accept management's isolated issues story, if we put that one bad loan in a box and set it aside for a minute, what does the rest of the business look like? Well, this is where that revenue beat we talked about starts to make a whole lot more sense. It actually paints a picture of a surprisingly healthy operation underneath all the noise.
This slide right here really captures the two competing stories from the quarter. On one side, you've got the headline risk, that scary $24 million loan. But on the other side, you have the bank's core engine, its actual profitability from lending, and it was firing on all cylinders. Their net interest margin, or NIM, expanded by a very healthy 13 basis points. And that strong margin expansion, it wasn't just some abstract number. It directly fueled a 5% growth in net interest income quarter over quarter. That's the bank's main source of revenue. It shows their fundamental ability to make money from lending isn't just stable, it's actually getting significantly better. And this growth, it wasn't just on paper. We're talking about real business being done. The bank's commercial loan production hit $215 million for the quarter. That's the highest level they've seen in the last year and a half. It signals real organic growth and that business clients are still knocking on their door. And it doesn't even stop with traditional lending. Their other businesses, the ones that generate fees, were also on a roll. Wealth management revenue was up 5%. Income from selling small business administration loans literally doubled from last year. And residential loan production jumped 20%. This kind of diversification across the board is exactly what you want to see in a healthy bank. Okay, so the core business is strong, we get it. But management knows they have a credibility issue now. They have to prove that this credit problem is truly behind them. So let's take a look at their forward-looking plan to see how they're going to try to do just that. First off, they're not cutting back. They're investing. They're bringing on new banking and wealth management teams in key growth markets like the Twin Cities and Denver. And this investment in people, that's the direct reason they had to raise their full-year expense guidance. So they're spending money now to drive growth later. They're also upgrading their tech. A new digital platform for their big commercial clients is set to launch in October. And an internal program called OneConnect is being rolled out to make everything in the back office run more efficiently. These aren't just costs, they are absolutely investments in being able to scale the business. Now, this is a major strategic shift. After years of just focusing on fixing things internally, the CEO is now signaling they are M&A ready. And they have very specific criteria, too. They're looking at targets along key Midwest corridors with assets between $500 million and $2 billion. But, and this is a big but, he made it crystal clear, they need to deliver a clean quarter first before they even think about pulling the trigger.
All right, so we've seen the bad headline and the strong core. We've heard management's plan. Now, let's put it all together and figure out what we should be expecting from here.
And that brings us to the ultimate question for any investor watching this whole story unfold. Given all this conflicting data, what's the trade? First, let's just ground ourselves in what management is explicitly telling us to expect. They see loan growth continuing in the mid-single digits. They expect that provision expense, the thing that caused all the trouble, to return to normal. And they think that core margin will just keep grinding higher by 4 to 5 basis points every single quarter. Now, if they hit these marks, the narrative completely shifts back to that strong core business.
So, our official take is a market perform rating, and that really reflects a cautious, constructive sentiment. We're constructive on the undeniable momentum in the core business, but we're cautious because, let's be real, management must deliver a clean Q3. They have to prove that credit event was an anomaly, not the start of a new, ugly trend.
Now for our outrageous but plausible trade idea. If you really believe management's story, you can bet on that M&A-ready posture. The play here would be to use long-dated call options to get some leveraged exposure. The idea is, once they deliver that clean quarter and then announce a smart strategic acquisition, the market could reward them in a big way for executing the plan. It's a bet that the turnaround story is real, and M&A is the final catalyst to unlock that value.
And of course, we always have to say it, this is not financial advice.